Such a pleasure to meet you. Well, how am I doing? Let's see. Today I went through hopeful. I need to call my mommy. Back down to maybe a little bit of hopeful by the end of the day. So we could talk about all of that.
It's me there, fixed it. Sorry about that. Okay, so look, all of that is very interesting, and it's certainly been a fascinating time in the market right now. But I need to dive straight into something that's been really on my mind, and that's I was watching the interview with Scott Bessent the other day on CNBC, and in many ways it was terrifying when you think about the Treasury Secretary talking about the things he was talking about. It struck me as so unusual that you see someone sitting in that role almost cheering on the prospect of recession. And I feel like that's a lot of what we've seen in the market today, where we've really seen some of that action on the back of what we're hearing out of the administration. So can we start off there? Like, how do you view this stuff?
Well, let's talk a little bit about the Sen for a second, because over the weekend, when I did a little bit of digging into his background, he worked with Stanley Druckenmiller. And so this is a serious guy. He is not a lightweight. And the other interesting thing about it is that I had to think for a second, who was our last Treasury Secretary? Oh, right, Yellen, because she never really said anything. And this guy has been extremely vocal. So between what he had to say, the seriousness of his background, and of course, Trump chiming in as well, I found it really odd that there are still people in the media and also on X, which I'm on quite often throughout the day, talking about buying a dip. I mean, at what part of not taking at face value do you disbelieve a man like this saying repeatedly, detox, we're going to detox, and then Trump himself talking about recession. So yeah, I mean, the fact that people are actually surprised about this is a little bit surprising. But even beyond that, I think the lesson here is, why are they doing this? And can they achieve their goals given the gamble that they're taking?
And when you think about that as a gamble, I mean, it is in many ways, because some of these actions, these policy actions, seem to be very untested when you think through what the implications potentially could be.
All right, and we have so many factors too. It's not just cut and dry. And I think maybe that's the most frightening part for me, is that they're very hyper-focused on a couple of things, but yet not really focused at all, seemingly, on the $36.5 trillion debt or our government spending of $7 trillion. I mean, I know Doge is trying to make some kind of inroads, but I don't know how significant that is when you hear tax cuts at the end of that conversation. Oh, we're just going to give money back to Americans once we stop spending money, which is kind of a bit of an oxymoron. And then, of course, I've heard theories about the fact that they want the $7 trillion worth of Treasury debt, which right now is very expensive to pay back given the higher interest rates, that the real plan here is to crash the market so bonds and yields go down, and then they can pay off the debt cheaper. And that just seems, I don't know, that doesn't seem, it's oversimplified, let's put it that way. So I guess the bigger questions is, if they're tariff focused, the last time we had this level of tariffs, of course, was 1930. We know that didn't work out so great. And then, of course, are we going to go recession? Or are we going to go more, which I think has been happening for the last couple of years, pointing towards a stagflation environment? This is not something new under the Trump administration. I've been talking about this now really since we came out of COVID. There was this huge growth spurt, of course, from nothing to back to business, but it never really showed its teeth in terms of strong growth within the United States. And that's why we were talking about stagnation of the economy, while prices, after the interest rates rose so steadily for 2022, now look like it was going to come back, the inflation part. And that's kind of where we're at right now. So this gamble, will it pay off? Will we bring everything back to the U.S.? Will our labor market thrive? Will we pay higher wages? And will that not create more problems for inflation? Are we pissing off our trading partners to the point where they won't really need us anymore? And, can we actually sustain a sort of an isolationist country? I mean, these are all questions I'm not even going to begin to answer, but I'm looking for the signs of it based on price action.
And there's so much in there that you've just discussed to unpack. And I do want to dig in a little bit deeper on a couple of those points, because firstly, I wonder how all of this impacts on the dollar and whether the dollar is some sort of escape valve in this scenario. Because as you've highlighted, there's a lot of risk. It is a gamble on some levels. And you pointed out the previous time when we've gone down this tariff path, it didn't exactly end well. So how do you see that in terms of, is the dollar at play here?
Absolutely. And I think that may be, well, today it stabilized a little bit, which was good because it looked like it was free falling. But then I was remembering last year, it did trade down to around, if you're looking at DXY, around 103.50, which is kind of where it's stabilizing from right now. So it's possible that the initial reaction was this fear that the dollar was going to become completely unraveled as foreign currencies and emerging markets and China were going to do much, much better. And of course, that's become the recent narrative. But it is possible that that might be our first sign that we could be a little bit overdone here, as if the dollar does indeed stabilize. Will that bring a little bit more confidence back into investing into the United States? Because it seems like money's been piling out as a result of that. And of course, if it doesn't stabilize, Chris, then we have to say, well, what happens if this thing starts crashing under this 103 level? You know, what happens when it gets down to 100? And what does that mean in terms of our status in the world? Because we know that China, Russia, Middle East, and now European countries are kind of pissed off. And that leaves the question, is this deglobalization good for us or not?
And that probably leads me to the next question in my mind around the debt. And you've highlighted this a lot, that it is a big problem, and it seems to be a problem that is not necessarily getting the focus that it deserves right now. How does that play in when you're talking about everyone else getting pissed off, for lack of better terminology, right? Do we have buyers in place to be able to buy all of this debt? Because there's a huge debt wall coming. We know that. Who's buying all this?
Well, that's part of the problem, right? You know, for years we relied on a country like China to buy our debt, and I think that may be one of the reasons why, when Trump is discussing China, he's been more conciliatory than aggressive, as he's been with Canada and Mexico, which I guess he feels he can bully more readily. China, not so much, because he's, you know, realistically, and you know, this is where actually having a mind like Vicent in the room is somewhat comforting to me, because I'm assuming that part of the goal is that this will emerge stronger, and we will emerge in better trading position with our import exporters that we've been dealing with, China being a big one. So, you know, we're hoping that this doesn't happen, where all of a sudden all these different countries, particularly China, stop buying our debt. In fact, you know, start selling off our dollar. You know, not taking our treasuries. This, now you're talking about a major collapse. And quite honestly, maybe this is the rose-colored glasses person that I am, really. You know, I don't believe that's going to happen. I've actually been taking like calls from hysterical relatives and friends in the last couple of weeks. And no, don't worry, you know, I mean, yes, you should have risk control in your accounts, but I would not worry about the United States defaulting. I don't think that's going to happen.
Because at the end of the day, I assume you would think they just continue to buy the debt themselves. I mean, we end up back in a quantitative easing regime. Is that how you would imagine? Like, ultimately, it can't fully collapse. Is that how you think about it?
Well, we do buy most of our debt ourselves. You know, the U.S. is the biggest buyer of our own debt. And, you know, I can't say, and I saw in your background that you were an economist, right?
Don't hold that against me.
No, but I would be more curious to know. I mean, you know, I am more of an armchair economist, because I can see things just as a human being who's been in the markets for a long time. But I would never, ever call myself an economist to the level of somebody who actually is one. So maybe you could put a little context on that in terms of what would happen if the U.S. is the only country, or at least the major country, and that's just balloons of buying our own debt back. Is that sustainable?
Well, while the US dollar remains a reserve currency, it is sustainable. That's, I think, the problem. And that's why when I'm asking those questions around the partners and people getting pissed off, like that is a real concern to me. I wonder if that part of the policy has been thought through, because when you talk about like the trade war retaliation, I think we're probably on the same page that when we think about Mexico and Canada and China in terms of the tariffs, we're probably looking at the wrong thing, because it's not the immediate tariffs and the consumer goods that are going to be the problem. To me, it's that debt.
Yes, absolutely. So, right. So you brought it round to the dollar as the world's reserve currency. And, it's funny because 2 years ago, I was all about BRICS and the threat of BRICS. And then I kind of let that go when the dollar seemed so stable over the last couple of years. So maybe that conversation comes back, and maybe it's just that I don't even want to entertain, in essence, the thought of the dollar losing its status as the world's reserve currency. And, of course, I also think about Bitcoin, because maybe all currency eventually is going to go away in terms of fiat currency. And perhaps, this is where maybe if it's not Bitcoin, some other coin we don't know about, but I still would bet on Bitcoin more than anything as being potentially the currency. And I'm not talking about in a year or two, but maybe 10, 15 years from now. So this all could be this just huge sea change that we older timers have trouble wrapping our heads around. But maybe that's the reset that's really needed, is the manipulation of the dollar and all the printing of dollars and other currencies through the years. Look where we're at as a result right now.
And I need to stick here on Bitcoin for a little bit longer, because I'm a big Bitcoin maxi. I love it. I love the concept. I love what it does as a trading asset. It's a great asset to trade. What's your thoughts around this at the moment? Because we had such positive news come out, and we've had some of the worst sentiment I've ever seen over the last week. Unbelievable, those factors offsetting each other. How are you thinking about Bitcoin right now from a trade perspective?
Well, what's so interesting is, and I'm in your camp, Chris. I am very pro decentralized currency, peer-to-peer networking, blockchain technology, the whole thing. And coming into this year, I thought, well, we saw 108,000. I thought maybe it was possible to get 125. So I felt that, okay, close enough. We got over 100. And then it became pretty obvious, there's that word again, maybe obvious to me, but not to so many other people, that with all this good news coming out between the Trump administration pro Bitcoin and then the reserve that they just created, and all the people that were in Trump's ear that are so pro Bitcoin having Michael Saylor go to Mar-a-Lago and all that, if we still couldn't rally after that, it became, again, use that word, obvious, that maybe we were going to see some liquidation. So that's what we're having right now. But it's, if you're looking, what I love about Bitcoin, besides all the stuff that we just mentioned from a fundamental standpoint, is how technical it is and how it trades so much like a commodity. And I am an old commodities trader, right? So that's where I cut my teeth in New York in the World Trade Center. I traded gold, silver, oil, sugar, coffee, and so I remember the days of the emotional parabolic moves, and then, the old staircase up, elevator down kind of thing, things coming and going out of fashion and cycling through. And that's how I look at Bitcoin right now. So we had the parabolic move, now we're getting more of the liquidation. So the question is, where does it find footing? So I thought today was interesting, actually, because the low since like November was 78,197. I think I wrote that down. And then it broke it today briefly and closed above it. So that actually made me a little bit hopeful that maybe the bleed is over, but we would have to do a little bit more than that, obviously. And I think today's high, when I say today, considering it trades 24 hours, but what I saw in one bar day was like 84,000. And I thought, okay, if we held 77, 78, that low of November, and now we're turning around and we can get back over 80 to 84,000, maybe the worst is that over. And if people get that, if that herd mentality switches from it's over to, oh my God, maybe this was just, some liquidation, I think it can go back up very quickly. If it doesn't do that, I still think I think we're close to the lows right here. I really do. And I know that's bold. But I think 74, 75,000 is where I would start to get interested in nibbling a little.
I'm very appreciative of that information there, because it certainly was a scary night over here for us as it was dropping down to those new lows, and you went, oh, what is that doing to the structure? But I want to get into a lot of the specifics, because I know you are a tactical trader, you do think about the specifics, but I just want to do one more thing, looking at that bigger picture first, and that's really to talk about stagflation, because it's something that I do worry about as something that's not potentially being addressed in the US when you think about what the risks are. And I think that's probably going to lead into a lot of the discussion around the technical things that you're looking at. So can you just give us a bit of an overview of how you're thinking about stagflation risks specifically at the moment?
Well, I think it could be a speed bump to recession, but if it turns out to be something more sustained, basically it's exactly what we're seeing right now. When you look at all of the economic statistics that have come out over the last, not just several weeks, but several months, the contraction in manufacturing, while prices are going up. Now the labor market, obviously, a lot of people are very interested in this week's jobless claims, because now the government jobs could start hitting the numbers, even though the unemployment last week didn't look that bad. There's been the trade deficit. We're still importing so much more than we're exporting. There's just a lot of indication that has shown that we have not grown as an economy. And as I said in the very beginning, that doesn't surprise me, because after the big rush coming out of COVID, it was obvious to me that we had to go from nothing, to 0 to 60 pretty fast, but we haven't gone over 60 miles per hour. And if the speed limit is 75 miles per hour, like it is where I live, and I know I'm speaking miles per hour instead of kilometers, we never got there. I have not seen any great growth, but what I have seen, because of supply chain, because of weather problems, because of now tariffs, and because of just war and geopolitical situation, I've seen lots of prices of things going much higher. Some of them have continued, some of them come off, but I have my trifecta of inflation that I think is something that we really need to talk about. And then that would mean to me that we may not get into hyperinflation, but it's stagflation. And then the last thing I'll say before I want you to probe further on that is, what does the Fed do about it? And I think that's probably the toughest thing. The Fed's gotten lost in all of this, by the way. Notice Jerome Powell said last week, oh yeah, the economy's in good shape. But he's got to be sitting there going, what do I do? Do I stop this free fall with this administration that wants to drive obviously prices much lower? And break the back, if you will, so that we can rebuild more in a USA? Or do I worry about inflation potentially getting out of control, which is why I said I'm going to do nothing. And that would only fire. Doing nothing to me is like lowering the interest rates in a stagflationary environment, because you don't help the economy and you don't stop inflation. And
I wonder how much of that is coming from the Fed, at least, is just pushback to prove their independence, really, because they don't want to be told what to do they? Like that's the whole point.
Yeah, exactly. Yeah. But they don't have to do anything. That's true, actually, in a way. They don't have to do anything right now, because there's so many other things being done that maybe the best thing is just sort of sit back and see. I mean, kind of like how I feel about investing right now. Sort of sit back and wait to see what happens before everybody's rushing in. Nothing gets me more angry than hearing all these people talk about, oh, just buy the dip. Oh, just buy. Oh, everything is so undervalued now. Based on what? I mean, these are just words, and that frightens me. And I think the Fed, I mean, I myself think they may pivot. I think that they may cry uncle at some point. I thought maybe even this month, but perhaps it will happen at the next meeting after this one coming up.
So I need to dig in further on that point you make about the inflation, your inflation trifecta, because inflation is certainly something that's been confusing, I think, to a lot of people watching it. I know if you look at the true inflation numbers that tend to lead a little bit, it's just inflation dropping right off. But is that just a temporary mechanism? How are you thinking about inflation? Because that's a really important point.
Again, I'm an old school trader, right? I don't believe the truflation numbers. I don't find the CPI, PPI numbers particularly reliable, or the PCE. I think that there's too much room to manipulate them, if you will, to make a more roseate picture. That's why I came up with this trifecta, because it's price. And my big mantra this year is price rules the narrative. And every time I start to get too much into somebody's narrative, I go back and check the price. So here's the trifecta. One is we've already talked about, which is the dollar. With the dollar's purchasing power so much less than what it used to be to begin with, obviously, if the dollar goes down, that's highly inflationary. And that means more than just a range. So I had the range for a while, 104 to 108. Now maybe it's 103.50 to 105. If we start to see that range really breaking down, that would be number one. Number two is, and again, I think we talked about this before the show started, I actually, for the first time in since COVID, or right post-COVID, when the stimulus came in, I'm flat, the metals. I don't have a gold or a silver position. I actually feel kind of weird. I'm having a withdrawal. Talk about detoxing. So, but what I will look for is for number two, silver to outperform gold. That hasn't happened yet. That has not happened yet. And even though gold's holding 2,900, silver's holding around 3,200, it's the relationship now that will get my interest back into it, rather than just buying it because I think gold's going to continue to go up or silver's breaking out to new highs. If I see that flip, that's inflationary. And then the third thing is sugar. And I've talked a lot about sugar on with audiences with Maggie and before that. And essentially, why sugar? Because sugar is a crop, right? So it has exposure to weather, drought, what have you. It's a food staple like rice. It's in everything. And from a psychological standpoint, having gone through this decades ago, sugar is the cheap solution to feed families when costs of whole foods get too high. And today corn went up and wheat went up. And so that in and of itself can be inflationary, but it's sugar in particular, because I've also know that people in certain countries will fight over sugar in a supermarket if there's 1 pound left on the shelf.
I think I'd fight over sugar if there was 1 pound left. That's just personal. I need to ask you specifically about the gold-silver ratio that you talk about there, because just as a sort of side question on this, I think at these levels, it could be almost a once-in-a-lifetime sort of trade opportunity for people who are longer-term holders, just to grab some silver with the intention of switching it to gold. How do you think about that?
Well, yeah, I mean, I actually have been more interested in silver, even though we held the gold position for quite some time. So I think that's, well, first of all, if it holds $32, I mean, right now it sold off today, but not horribly considering the sell-off that we had in the overall indices and some of the stocks. So that's probably a good sign. But here's the thing about silver and gold, but mostly silver. When it starts to look really good, it's been time to get out, or certainly not time to buy. And when it starts to look really terrible, it's been time to buy and not time to go short or become a bear. And yet people get fooled, right? They get bullish at the high and bearish at the lows. When that changes, when we start to see silver go up and then go up and then go up with no sellers around, we know that paradigm has shifted and now silver's on its own fumes. So that's number one. Number two is the silver to gold ratio has been around 90 to 1, which means gold's trading about 90 times the price of silver. 80 is kind of like my number in my head right now. We start to see that relationship break down under 80. And in 1980, by the way, speaking of 80, in 1980, the ratio went down to 17 to 1. So that shows you how much room we have for silver to go up versus the gold. That doesn't mean gold collapses. It just means gold stagnates and silver goes. Phew. So that would be the other thing, is if it breaks 80 in terms of that ratio, and that's an easy thing to find out, a lot of places will show a chart of what that ratio is. That would be a second signal.
Yeah, wonderful. Now, look, I need to wrap this up, not right now, but I need to get to the most important thing for me, which is the way you think in terms of frameworks. I really love that, because it's so important, I believe, to be able to make consistent investment decisions correctly, that you're following some sort of framework. You talk a lot about your economic modern family. I know people who are watching this will have heard of that before, but I would love for you just to give us a bit of a breakdown of that again, because I just think it's so important, that framework that you use. Maybe a bit of an update on where we are in that, and if you can then lead that into some of the key sectors that are involved and how you're seeing it at the moment.
Yes, and I hopefully leave people a little bit with some of my rose-colored glasses on their nose, because the economic modern family has always been, well, I shouldn't say always, I created it, but since the creation, been my guide, because it's the small caps as the grandfather of the U.S. economy. And if you think about it, that's logical. The whole tech boom, as fun as it was, I never really was convinced showed that we were in a growth economy, because grandpa has been lagging, I call him grandpa, for a long, long time. And that ratio got really stretched. And that's why all the analysts came out and said, oh, the market's going to broaden out. It's all about buying value stocks. It's all about buying small caps. Well, they're not feeling so good right now. But what's interesting about IWM, if I like to talk about the ETF, is I look at the daily, yes, I look at the weekly, yes, but I look at the monthly chart. And one of the things from an economic standpoint that I discovered a while ago was the 23-month moving average, which has been an unbelievable guide with the family of telling us whether we're in economic contraction in a particular instrument or even stock, or economic expansion. And we broke into expansion after COVID in IWM, and we cleared that 23-month moving average. Today, we're on it, right? We're on it. So that's number one. Number two is retail would be the second most important thing to me in terms of the family. And I've got other members. We won't talk about them all because we don't have time, but I want to talk about four. Okay, so granny retail, obviously I call her grandma. That's just kind of after my own grandma, who walked with a cane until she went into a supermarket or a department store. Then she would, throw that cane away and walk. Great, because we do get an adrenaline rush out of spending money. We love it, right? And it's 70% of the GDP. So that was my first clue, by the way, that we were going to have this massive sell-off, the most recent sell-off, because retail broke down first. But now also sitting under the 23-month moving average, but it's March 11th. What's today? The 10th. So
11th here.
Yeah. Okay, 11th there. Right. So that means we still have 2 weeks. If we can get back over that 23-month in the retail sector, and IWM can hold around this 200 level, and XRT would be really between 70 and 72. We don't want to break 70, but if we can get back over 72, that's where that 23-month comes in. Then I actually think I could pretty much be maybe one of the first to say the worst is over. If it doesn't, forget it. Then that's granny can also put the nail in the coffin if it breaks down under 70. IYT would be the sort of the third of the inside sectors, another Druckenmiller expression in terms of the U.S. economy, because transportation is also super important. That's actually still holding right above its 23 months. So if you put those three things together, what you're really coming up with here right now is we were in a level of contraction post-COVID, even through the rates going up, and then of course the rates sort of pausing and then coming down 1% last year. That was all enough to keep us in an expansion. But now we're sitting right there at the precipice of potential. Either this was the dip to buy, or forget it, we're going back into economic contraction ergo stagflation or recession. And then just behind that, I would say semiconductors is important because that's in the family too. That was my sister's, my Wonder Woman, if you will, for so long. And that peaked out in July. And that's when people everywhere would ask me, and I say everywhere, I mean on media, especially mainstream media, well, would you buy tech here? Oh, well, would you buy tech here? Oh, what do you think of NVIDIA here? That's all that anybody ever asked. And I would say, no, it's peaked. And they would look at me with like these saucer-wide eyes. How could you say that? It's like sacrilegious. But clearly, now that has a little bit more room to the 23-month moving average SMH. But again, that would be a very key area to watch.
I'm running a little bit over, but I can do that because Maggie's not here and she can't yell at me for doing that. So I have to also ask you, what are your plays right now? Because I think I won't get away without asking that. Do we have some growth plays, defensive moves? What are you thinking?
Well, I'm in a lot of cash right now, but that's by design because I want to shop and I want to have money to shop with. I don't want to I didn't want to see my portfolio go down more than 10-15% from, and that was including the profits gone. And now, we're back to like square one. I didn't want to lose much money after that. So I went to cash. And I've had some good winners in there too. So IBM, let's talk about that. That's been fluctuating with the market, but still holding up very well. So that would be possibly an add. But maybe and DBA, because if we are looking at inflation, that's the agricultural ETF. It went up almost to 29, has come all the way off down to around 26. And now with the crops today, corn, wheat, and now sugar and coffee rallying, I think 26.80, I might be inclined with a relatively low risk to get back into that. But the last thing I'm going to say is about the vanity trade, because that's been my other moniker. I like trifectas and Modern Family. I like to call things because it's easy for people to relate. So I have my vanity trade, which is based on the diet drugs, which could be a huge growth for the consumerism in the US, some projecting perhaps 6% of the GDP based on spending habits changing from people who have lost weight and can keep it off. So I have a few areas there. So Ulta reports this week. I'm very interested in that because it may have a massive double bottom. And one thing about recession, at least I know as a woman, you still go out and buy makeup and get your hair done because, you're already feeling miserable. You don't want to look miserable. And so new skin is emerging from a base. I saw today e.l.f. Beauty started to rally, was up at one point today, 6%, I think closed about 5% higher. Anything that has to do with the domino effect, healthier eating, although McDonald's has done very well lately, so that kind of blows that theory, but still. Maybe because
McDonald's might be my version of the makeup when you're in that depressed state. You just have to get some. I don't know how that works.
Well, McDonald's, I think, had a lot to do with eggs because they didn't raise the price of their Egg McMuffins. But no, but seriously, even Match.com has been holding miraculously well through this sell-off, and it was such a beat-up stock. So I'm starting to Nike, think Peloton, anything where people will go from obesity their whole life to now having a whole new lease on life. And what does that look like? That's what I'm looking at as well. Besides, I also like Adobe, like I mentioned, IBM, and Stratasys, which is a 3D printing company, but they're making all of the parts for NASCAR cars for the racing, which I think, is a huge sport in the US. So I guess the bottom line is this. I don't want to necessarily be interested at this point in the high flyers that are coming off looking for the dip. I'd rather be looking at the things that have been basing throughout the last several months that are thematic because maybe they're more AI software, or they're more in the vanity, or they're more in the agricultural, or companies that actually feed people that have pricing power, coming out of a base where I have a much more controlled risk.
Well, thank you so much for that discussion today, Mish. I'm a huge fan, and it's been such a privilege to be able to dig into your thoughts on a wide range of topics because it's really the perfect time when all this is happening. The markets are so challenging to get that little bit of alpha. So thank you very much. Is there anywhere people can go if they want to get a little bit more of a deep dive into what you've been discussing today?
Well, one of the things I really wanted to mention is that my pinned tweet, X, post, whatever you say these days, is my Outlook 2025. It's also, if you go to our website, marketgauge.com, it's free. And it's everything that's going on, I kind of have been talking about. And in my top 10 list, Kratos is on my top 10. IBM is in my top 10. Salesforce doesn't look so great now, but that was in my top 10. Ulta, there's a whole list of stocks. If you take a look, and I showed the charts, the 23-month charts, it might help at least for you to understand where I'm at, especially when we talk about the metals. And I think that would be a good report for you guys to pick up.
Thoroughly encourage everyone to do that. Thank you again. Thank you everyone for watching. And as Maggie would say, take care and good luck out there.